Plug Power is currently trading at $2.89, down a significant 7.53% for the day. And while a glance at the broader market might suggest this is just another tech stock caught in a downdraft, the truth of this decline is far more specific and deeply rooted in the mounting pressure between the company's ambitious vision and its precarious financial reality. The intraday action tells a brutal story. The stock opened at $3.04 and even attempted a brief rally to $3.11, but the selling pressure was relentless, driving it down to a new low of $2.87 before finding any semblance of temporary support. This isn't random volatility, it's a calculated retreat by investors who are growing increasingly impatient. The long-held expectation for Plug Power has always been a grand one. It was supposed to be the linchpin of the coming hydrogen economy, a vertically integrated giant providing everything from the fuel cells powering forklift fleets for Amazon and Walmart to the green hydrogen itself, produced at its own state-of-the-art facilities across the nation. The narrative was powerful, a company at the forefront of decarbonization, solving the intermittency problems of solar and wind, and building the infrastructure for a cleaner future. Investors bought into this story, picturing a future where Plug Power's hydrogen stations were as common as gas stations are today, fueling long-haul trucks, powering data centers, and stabilizing the electrical grid. This vision is what propelled the stock to dizzying heights in the past and what keeps a dedicated base of shareholders holding on. However, the reality that is crashing down on the stock price today is one of relentless cash burn and operational headwinds. The beautiful story of a green future is being overshadowed by the ugly mathematics of a company that has struggled to achieve sustained profitability. The core of the problem lies in the gap between producing and selling hydrogen and doing so at a positive margin. Building out a national green hydrogen network is an incredibly capital-intensive endeavor, and for years, Plug Power has funded this expansion not through operational profits, but through issuing new shares and taking on debt. This continuous dilution means that even if the company succeeds, each existing share represents a smaller and smaller piece of the pie. The market is now looking past the glossy presentations and asking a very simple and very harsh question. When will this company be able to stand on its own 2 feet financially? The current high interest rate environment only amplifies this concern. When capital was cheap, investors were willing to fund speculative growth stories for years. Now, with borrowing costs high, the market is demanding a clear and imminent path to positive cash flow, something Plug Power has yet to convincingly demonstrate. This brings us to the immense pressure from short sellers, a factor that cannot be ignored when analyzing Plug Power's recent performance. The stock has long been a favorite target for bearish investors, and the current short interest remains stubbornly high, often hovering above 20% of the public float. The thesis from the short side is straightforward and punishingly logical. They are betting against the company's ability to execute its grand plan before it runs out of money. They point to the negative gross margins on fuel sales, the repeated delays in project timelines, and the company's dependence on government subsidies like the Inflation Reduction Act's 45V tax credit for clean hydrogen production. Their argument is that, while the technology is interesting, the business model is fundamentally flawed and unsustainable without perpetual access to cheap capital or massive, reliable government support. For retail investors, it's crucial to understand how to monitor this. You can track short interest data on platforms like Fintel and Ortex. Pay close attention to the cost to borrow, which is the interest rate short sellers must pay to borrow shares. A spike in this rate can indicate that the supply of shares available to short is dwindling, sometimes preceding a short squeeze. However, it can also signal that conviction among bears is deepening, and they are willing to pay a premium to maintain their negative bets. What's your take on the rising short interest? Smart money or manipulation? The recent trading volume accompanying this price drop is particularly telling. On days with sharp declines like today, we often see volume that is significantly higher than the daily average. This suggests that the move isn't being driven by a small number of retail traders, but by larger institutional players rotating out of the position. While index funds and passive ETFs will maintain their holdings, active fund managers are likely trimming their exposure, unwilling to weather another quarter of heavy losses and uncertain guidance. These are the investors who are more sensitive to macroeconomic pressures and balance sheet vulnerabilities. They see rising energy costs, potential gridlock in Washington affecting subsidy payouts, and intensifying competition from other players in the hydrogen and battery space, as compounding risks that make the Plug Power story a much harder sell in the current climate. For those less familiar with the company's core operations, Plug Power operates in several key areas. Its foundational business is providing hydrogen fuel cell systems, primarily for material handling equipment, the forklifts and other vehicles you'd find in massive distribution centers. This segment provides a steady, albeit lower margin, revenue stream. The big growth story and the source of most of the company's capital expenditure is its push into the green hydrogen ecosystem. This involves manufacturing electrolyzers, which use electricity to split water into hydrogen and oxygen, and building and operating liquid green hydrogen production plants. The strategy is to create a closed-loop system where they not only sell the hardware, the fuel cells and electrolyzers, but also secure long-term contracts to supply the hydrogen fuel, creating a recurring revenue model. This vertical integration is ambitious, and if successful, could create a formidable competitive advantage. The problem has been the execution and the cost. The company has struggled to get its major plants in Georgia and New York running at full capacity and at the projected cost, leading to missed revenue targets and widening losses. Looking ahead, the future of Plug Power hinges on a few critical catalysts and a number of substantial risks. The biggest potential catalyst is the finalization and implementation of the Treasury Department's guidance on the 45V tax credit for clean hydrogen production. This credit is designed to make green hydrogen cost competitive with hydrogen produced from natural gas. Favorable guidance could unlock billions in value for Plug Power and significantly improve the economics of its production plants. Another major catalyst would be the announcement of new large-scale contracts for its electrolyzer business or a significant expansion of its fuel supply agreements with existing major customers. On a fundamental level, the single most important thing the company could demonstrate is a clear, sustained improvement in its gross margins. A quarter where the company shows that it can sell hydrogen for more than it costs to produce and deliver would be a massive turning point in investor sentiment. However, the risks are equally significant. The primary risk remains further shareholder dilution. If cash burn continues at its current rate without a corresponding increase in profitable revenue, the company will inevitably have to raise more capital by selling more stock, likely at these depressed prices. There is also significant execution risk. The company has a history of overpromising and under-delivering on timelines and financial targets, and another major project delay or operational mishap could permanently damage management's credibility. Finally, the competitive landscape is not static. Established industrial gas companies are entering the green hydrogen space, and advancements in battery technology continue to present an alternative solution for many of the applications Plug Power is targeting. The expectation is a smooth ramp-up to profitable scale, but the reality could be a much more difficult and costly battle for market share. Let me know in the comments below, how many shares of Plug Power do you currently hold, and what is your long-term outlook? In conclusion, the sharp 7.53% drop in Plug Power stock today to $2.89 is not an isolated event, but a manifestation of the deep-seated conflict at the heart of the company. It is the battle between a compelling, world-changing vision of a hydrogen-powered future and the harsh, unforgiving reality of a challenging balance sheet, operational struggles, and intense scrutiny from short sellers. The market is tired of hearing about the potential for tomorrow. It is demanding tangible results today. The path forward for Plug Power is no longer about selling the dream, it is about proving it. It can build a durable, profitable business. Until the company can bridge that critical gap between its visionary expectations and its financial performance, the stock will likely remain under pressure, a battleground for bulls who see a generational opportunity and bears who see a cautionary tale of ambition outstripping execution.